for the fourth video of the advanced management accounting. From the first, second and third video we have completed variance analysis and standard costing. This is the fourth video. Today we are going to start another session, another topic under a specific chapter. The chapter name responsibilities and accounting, that is chapter 9 of your first volume of advanced management accounting study text. The responsibilities and accounting is a huge area which covers three aspects of the syllabus. Basically, responsibilities and accounting we can divide into three categories. The first one, the introduction of responsibilities and accounting and the theoretical aspects of responsibilities and accounting. The second point is the transfer pricing. Third is the performance appraisal. First I will explain what is it. The responsibility center means when you take an organization, let's take Toyota, Japan, right? They are producing cars, motor vehicles. Now Toyota, they are not producing motor vehicle within a one house. They have decentralized divisions in different places producing different component of the car. For example, let's say like this, one division producing the chassis, another division producing the other component of the vehicle, then another division assembling all the things, another divisions making interior design and interior making part, then another division doing the electrical part, the wiring and other area, lighting, those things. Likewise, different departments doing the manufacturing, and finally they are getting the final product. Now these divisions generally, practically we call responsibility centers. Is that clear? If I explain further, let's take, say, a garment factory. Garment factory. This garment factory may have different department. For example, they have purchasing department. They are purchasing raw material they required, clothes and other things. Then they will transfer those into cutting department. Cutting department will cut the pieces in according to the design. Therefore, they may have another design or related department, those who design the garment or those who make the garment according to the customer requirement. Then purchasing department, design department, and between purchasing and design also have a communication. Why? Customer generally makes the request to the design department or a sales department. Let's take sales department. Customer make the request to the sales department. Sales department then send it to the design department to design the product. Then design department requires to design the product by communicating with the purchasing department, because purchasing department required to purchase material according to the design. Then design and raw material will go to the cutting department. Then cutting department will cut the pieces for the required quantity of production. Then it goes to sewing department for the manufacturing. Then it goes to packing department for packing. Then finally it goes to the sales department. Then sales department will hand over product to the customer. Now look at these centers. In addition to this department, that garment factory may have finance department, human resource management department. Likewise, different supporting departments they also have. Now see, each department they are doing different works, right? They are doing different works. For an example, HR department just handling HR. For those purpose, they make cost, they incur cost, but HR department not make sales, not generate income, they are generating only cost. Therefore, this can be considered as a cost center. This is a cost center, just incurring cost only. Finance department also, it's a supporting department. This is not making any revenue, they are generating only cost. Therefore, this is also a cost center, right? The purchasing department also a cost center because they are incurring cost. Cutting, civil department, design, they are cost centers. But sales department making revenue because they are selling item to the customer as well as they are incurring cost. Therefore, that sales department working as a profit center. Likewise, in responsibility center accounting, we will identify different departments in the organization and classify into 4 departments: cost centers, revenue centers, profit centers, and investment centers. What is the difference between these centers? Cost center only incur cost. They only incur cost, not generating any revenue. Revenue center only generating revenue, no cost there. When it's come to profit center, they are incurring cost and they are generating revenue also, right? When it's come to the investment center, they are incurring cost, they are generating revenue, and they are making investments, that is fixed asset purchases also for the department. These are the major differences in these responsibility centers. Therefore, the responsibility center lesson explain the different department that company having can be classified under these 4 categories and their characteristics and how their performance should be measured. Everything explained in the first part of the lesson, that is responsibility center introduction. Thereafter, they have another 2 specific topics. Those are transfer pricing and performance appraisal. Then I will tell what is transfer pricing. When the cutting department make the cut piece, that cut pieces has to be transferred to the other department. Clear? Then they have 2 options to transfer cut piece to this department. One, they can transfer it at cost. Clear? Then they will made it, then they will transfer it to the packing department also at cost. Finally, packing department sell it to the sales department at cost. Then sales department will add the margin, cost plus margin, and sell it to the customer. In this model, only sales department making revenue. Therefore, sales department always performing with the profit. Other department just incurring cost. Therefore, at the performance appraisals, these cost centers just show the cost incurred and they are not performing, so they are, it is not actually happening, but according to the performance appraisal, people believe sales center making profit, they are making revenue, others are incurring only cost. Therefore, these are not the best or profitable departments to the organization. Somebody can believe like that because they are just generating cost, but you know they are the people who contributed to the final product. Clear? Even sales make the revenue, they have made the product. Since it transfer at cost, they are just presenting their cost. They are not presenting the contribution to the towards the revenue. Therefore, company generally ask each department to transfer their product not at cost, at a specific price. Through this price, each department can show a revenue, and through this pricing method, each department competing each other and try to have a their divisional profit. Finally, this will cause to increase the entire profit of the organization. Is that clear? Therefore, transfer item from one department to other department entities using a price method, that's called transfer pricing. That is the second part of the syllabus, the chapter. Finally, third part of the chapter is the performance appraisal of each department. Therefore, responsibility center accounting consists of three parts: the introduction and explanation of the responsibility center and their aspects, transfer pricing, and performance appraisal. What I am going to do through this video, I am trying to explain this transfer pricing topic. Generally, you know, when you are doing management accounting, you know you have variance analysis, budgeting, transfer pricing, performance appraisal. Likewise, you are telling topics like that, but that is wrong. You have topics as chapters. Within each chapter, you have different areas to learn. You do not have a separate chapter as transfer pricing. Your chapter is responsibility center accounting. That is thinking about, managing about different departments within the organization. Under this topic, you need to learn three things: the introduction part of the responsibility center, transfer pricing, and the performance appraisal. You can see there is a link. The divisionalization, dividing organization activities into different divisions, then transferring their product into other division, transfer pricing, and appraising their performance at the end, performance appraisal. Therefore, all these three things need to be learned as a one package. That's why you need to learn responsibility center accounting chapter, not only transfer pricing. However, why I have given you a basic understanding about the chapter, otherwise you won't understand what is transfer pricing. Now you know what is transfer pricing. This is arise as a result of divisionalization. Once the organization divide their functions into divisions, that divisions requires to transfer their product into the other division until it goes to the customer. That's why we are talking about the transfer pricing. Okay, let's start the transfer pricing topic today. Right, before moving into the study text, I will explain with a simple example. Let's say there is a company, computer sales company. Their business is computer sales, selling computers, right? Say this company is COM PLC, COM PLC is the company. Right. Their business mainly consists two divisions. One, let's say number one as manufacturing motherboards, right? Manufacturing motherboards. Let's take the other division as assembling and sales. These are the two divisions that COM PLC having, right? Now let's see what they are doing. Motherboard divisions will buy raw material and producing motherboards. According to the structure of the company, they will transfer, that motherboard manufacturing division will transfer motherboards to the assembling and sales division. Then sales division will assemble this motherboard with other part of the computer and sells it. They are selling it to the customers. right. Now let us see what's happened. This is the company's boundary, right. This is the company's boundary. That Comp PLC totally given independence of each division, they can do what they want. They have two different managers, say manager 1 and manager 2. They are always trying to maximize their own division profit. Likewise, Comp PLC already given the autonomy for 2 managers. Now, this company, if they want, they can sell motherboards to the outside customers instead of transferring into the other division of the company, or they can transfer. They are doing both sale and transfer. Clear? Assemble division also can take motherboard from their own division, or then they can purchase motherboards from outside suppliers. Clear? Because they have the autonomy. That's why I told you that company already given the autonomy to the 2 divisions. Manufacturing division own part of the organization, assemble division also own part of the organization, but they have the autonomy, they can do their own things. They can manufacture as motherboards, sell it to outside customer, or transfer into a own division. This division also can purchase motherboard from their own division, no, they can buy it from the outside. Clear? In this type of situation, that managers wants to maximize their profit, how they do it? That is transfer pricing. Let us assume figures here. Let us say manufacturing division will produce a motherboard, say unit, 1 unit. The variable cost, let us say 100 rupees, 100 rupees per motherboard. Fixed cost per unit, say 50 rupees per motherboard. They are selling it to outside customer to 200 rupees. Clear? Okay. Now let us see assemble division. Assemble division can purchase a motherboard from outside supplier, right, say at 110 rupees, right, and they are selling their computers to outside, say 300 rupees, that is the final product. Now, see what happened. Manufacturing division will produce a motherboard at 100 rupees with a variable cost, incur another absorb fixed cost. The fixed cost absorb is the entire fixed cost of the company. Out of the entire fixed cost, they absorb 50 rupees per one motherboard. Therefore, their total cost 150. They are selling it at 200 rupees to outside. If this manufacturing division transfer this motherboard at the same price of 200 rupees to the assemble division also, they won't buy it. Why? Because this manager feels I can buy this same assemble from outside supplier at 110. Then why I pay 200 rupees to my own division? Because we have the autonomy. We are independent. Even we are in the same company, we are independent. Why I pay 200 rupees for the same motherboard? Because outside supplier supply it at 110. Therefore, they will buy from the supplier, not from the owner division. Clear? This will be make profit or losses to the entire organization. How? Let us see like this. The entire market demand, customer demanded 1000 units, right? They can produce their capacity, say 1500 units capacity. That means they can produce 1500 motherboards. They are working at full capacity, but they can sell 1000 only to the outside customer. Then what happened to the balance 500 units? Their only option is to transfer to them. Is that clear? Try to understand this concept. Then you can easily handle transfer pricing questions. Their capacity to produce 1500 motherboards per annum, but external market demand only 1000 motherboards. Therefore, out of 1500, they will sell 1000 to the outside at 200 rupees. Then balance 500 units. Their only option is to transfer into the assembled division within the organization. If assembled division reject this item since it is highly cost when comparing to the outside purchase, they won't buy this 500, they will buy it outside. Is that clear? Then what happened? They won't be able to sell additional 500 units, which incurred directly 100 rupees per unit. Therefore, they will have a low cost. Clear? Internally, actual cost is only 100. Why? That is variable cost. Because this fixed cost is the company's entire fixed cost absorbs to the department. Even they produce motherboard or not, they have to incur this fixed cost. Therefore, this is not a relevant cost. This is the relevant cost. They incurred 100 rupees per motherboard. Now they have 500 units unsold. No market. Because their own assembled division also buying outside since it is cheaper. Right? Therefore, this division has to reduce their price, that item transfer to the assembled division. They know if they are unsold, their loss is 100 rupees because this is the relevant cost. This is irrelevant. Right? If they are unsold, they have a cost of 100 rupees as a loss. But if they can transfer at least it at 100 rupees to them, they can recover their variable cost. Because if they ask, okay, buy it from 100 rupees, they will definitely buy from this division since this is 110. Clear? Therefore, to minimize the loss to the organization, to minimize the loss, they must reduce this price from 200 to at least 110. Then assemble division buy entire 500 from their own division, then balance will buy from the outside. Through this type of strategy, company can have finally their profit. This strategy called transfer pricing strategies. Our lesson today we are going to learn how the divisions can handle, companies can handle this transfer pricing strategically to maximize organizational goals under different scenarios. Why I have told different scenarios? Here you have a limited demand. Here you are producing more than the demand. It's a one scenario. Market have limited demand. We are producing more than that. Sometimes other scenario. Market will ask 10,000. You are producing only 1,500. You are not supplying full demand of the market. Another scenario. Like perfect competition market, oligopoly market, then monopoly market, monopolistic competition market, different market scenario. In this type of different market scenario, how company can manage their transfer price? We are going to learn this. Okay, let's move into this study text to have the additional theoretical aspects of this transfer pricing before moving into the computation. Moving into our computer screen, the transfer pricing topic, it is in the page number 275, right? Transfer pricing. Here you have a description. Let's see what is it. Better to have make highlights, underline everything because you have the study text. Transfer prices are a way of promoting divisional autonomy. I think now you can remember what I have explained. I told you transfer pricing will make the independence of each division within the organization. Ideally, without prejudicing the measurement of divisional performance, the discouraging overall corporate profit maximization. Transfer price should be set at a level which ensures the profit for the organization as a whole are maximized. I told you. Finally, this transfer pricing strategy will focus to maximize the entire entity's goals. Right? The limits within which transfer price should be fall are as follows. That means I have told in my example, I will take you again into the whiteboard. Look here, the external market 110 rupees, internal variable cost 100, they are selling it outside 200 rupees. They can buy motherboard from outside 110, clear? They can sell motherboard to outside 200. But they can't sell 500 units to outside because demand is 1000. They have more 100, 500 units. Therefore, they have to reduce at least price to 110. Therefore, when an organization decides in their transfer price, there is a limit. What is called limit? There is a range. Within this range, now maximum price they according to this scenario 200 rupees here. Lowest price they can ask 100 variable cost, but they can't even charge 200 and they can't sometimes charge 100. There may be a limit, maximum limit and minimum limit, right? That is this area. Now, in this limit, the price can be decided. Within this area, sometimes price can be, that is transfer price, right? Transfer price can be decided, right? Within this area, you can see we have two ends. That two ends name here as maximum and minimum price. Let's take again the computer screen and let's try to learn what is this maximum and minimum price. That is the two ends of the range. Clear? Moving into the computer screen. The limits within the transfer price should fall as follows. The minimum and the maximum. Right? Let's read it first. The minimum. The sum of the supplying divisional's marginal cost and opportunity cost of the item transferred. Maximum. The lowest market price at which the receiving division could purchase the good or service externally, less any internal cost saving in packing and delivery. Don't worry about these explanations. Let's discuss with the calculation, then you can easily understand. If variable cost and market prices are constant, regardless of the volume of output, a market based transfer price is the ideal transfer price. So, one scenario. Don't worry about this. We have to learn this one by one with examples. Then they have explained what is a transfer price. Since I already explained to you, I am not going to read those areas. Then main uses of transfer price, the advantages of transfer price, that is very important. Why? Examiner can be tested what are the advantages or what are the purposes of transfer pricing. You have been given here purposes, just read it and understand. I am not going to discuss those theoretical areas. Then you have the disadvantages of transfer pricing, problems with transfer pricing, just read and identify it. Let's move into the complex part of the here. You can read and understand these advantages and disadvantages of transfer pricing. Therefore, I will skip this part. Then there is a question, the benefit of transfer pricing. You can practice it and answer also given. Then we are moving into the minimum and maximum prices, right? Right, I have told you we have two range, minimum price, minimum transfer price, I will use TP as transfer price, other one maximum transfer price. Right, let us see the meaning of these two. The meaning, what is minimum? Refer your study text also. The minimum sum of supply in division marginal cost plus opportunity cost of item being transferred. Therefore, we can say marginal cost of production plus opportunity cost. That is the meaning of minimum price. Marginal cost of transfer, sorry, marginal cost of production and opportunity cost of selling it outside. This is the minimum price. Then let us see what is maximum price. The lowest market price at which the receiving division could purchase the item from outside, less any internal saving of packaging and delivery. What is maximum? Now I have told you in my example that assembled division can buy motherboard. Can you remember my example? Go back to the video and remind it again. Assembled division can buy the motherboard from their own division or from the outside customer, right? That is the autonomy that assembled division having. Now assume you are the manager of assembled division. You can buy it from your own division or you can buy it from outside suppliers. Select outside suppliers. You have different outside suppliers. They have different prices. The lowest price that outside supplier supply, that you have to select. The lowest outside price, right? Lowest outside price, that or external supplier price. Lowest price that is outside, right? That is in the market. This is the price you can buy at lowest from the outside. But if internal division transfer motherboard to this assembled division, they are not required to packing it, design it, because it is an internal transfer. You know, when you serve the lunch, your own family member at your home, you are not required to design the lunch. Just prepare and serve it. But when you are serving it to a guest, you are designing it. Clear? අපි ඒක සාමාන්‍යයෙන් දන්නව නේද? පිට කෙනෙක් ආවම තක්කාලි පෙති කපලා තියලා, දෙහි පෙති කපලා තියලා, කොළ කෑලි තියලා මේ අමුතු මේක තොරණක් වගේනේ බත් එක ගිහින් මේසෙට තියලා වාඩි කරවලා කව. හැබැයි ගෙදර ඉන්න මිනිස්සුන්ට බත් එක බෙදලා දෙද්දි පිඟාන ගත්තා. ඕක හොදන්නේ නැහැ. බත් ඇටි දෙක තුනක් ගහලා දැම්මා. හතර වටෙන් හොදි ටික දැම්මා ගිහින් දුන්නා. ඒතර ගෙදර ඉන්න මිනිස්සුන්ට බත් දෙනවා කියන්නේ internal transfer. The serving the lunch for the internal organization, just like serving the lunch to your family member. Selling it to outside is just like serving to a guest. Now you can understand. Not required to packing it. Not required to design it when you transfer internally, right? For example, take a bakery. Say there is a bakery, they are producing breads. They can transfer their breads to an internal division who producing sandwiches, or they can sell breads to outside. When you sell breads outside, you need to pack it, you need to design it and sell it to the market. But when you transferring breads to the internal sandwich producing division, you just put them into a bag and send it to the division. No need to pack it. Therefore, through an internal transfer, the transferor will have a cost saving. What is the cost saving? No need to pack it. No need to design it. You can just transfer. Therefore, the maximum transfer price is lowest price outside market minus cost saving from packing and delivering Sometimes you need to deliver into somewhere. Long distance you need to deliver it. You need to pack it to attract customer. But when you transfer internally, you no need to pack it, you no need to deliver it. There is a cost saving, right? Cost saving from packing and delivering. You will select the lowest price at the market which the transferee can purchase it. Then you will deduct packing and delivery cost because you can save it. Now see the definitions of two prices. Minimum price, marginal cost of production plus opportunity cost. If you transfer internally, you will make a loss because you will lose the opportunity to sell it outside. Clear? When you serve your lunch, your prepared lunch to the family member, that is the internal thing. You don't have bigger evaluation for you. But when you serve that packet, lunch packet or lunch plate to the neighbor, he will appreciate you. Now what happen once you serve it to the internal family member? You will lose the appreciation. හැමදාම කාලා හැමදාම වගේ මෙලෝ රාක් නැහැ කියලා පිඟාන හොදලා යනවනේ කාපු එක. පිටේකට දුන්නා ඒක කාලා රස නැතුණත් රසයි කියන. That is the appreciation when you are getting from the outside. සුරාජු තිනා වෙන මොකක් හරි experience එකක් ඇති. right cut කරන්න එපා සුරාජ් මේ part එක. නම සුරාජුත් අල්ලපු ගෙදර එක්කෙනා බත් දුන්නම appreciate කරනවා ඇති. හරි. ඒ අල්ලපු ගෙදර එක්කෙනා ගෙදරම කෙනාට බත් දුන්නම ඒ මනුස්සයා appreciate කරන්නේ නැහැ. Now when you transfer internally, you are not getting the appreciation. That is the opportunity cost. Now see, take it into the business. When a division sell outside, they have a margin and they will make the profit. But when they transfer internally, they have to reduce the price and they will lose the margin. That loss margin is the opportunity cost. Therefore, minimum price is the marginal cost of production plus opportunity cost. Maximum price is the lowest market available price for the product producing minus cost saving, because internal transfer will save the packing cost and delivery cost. Sometimes any additional cost you can save. Now let's see how this can be computed using a practical example. Moving into the computer screen, there is an example. Division X produces product L at a marginal cost per unit of 100,000 rupees. If a unit is transferred internally division Y, rupees 25,000 contribution is foregone. On an external sale, the item can be purchased externally 150,000. Now, they require us to calculate minimum price and maximum price. Here, the question, the two prices also given here, but let's see how it can be arrived. Moving into the whiteboard, that division X producing this item. Now, division X is the producer of this item. Division Y is another division of the same organization, within the same organization. They can produce it and sell it outside to 125,000 because their marginal cost of production 100,000, right? If they sell outside, they have a margin that is the profit 25,000. If they transfer it internally, they cannot have this profit since they have to transfer it internally and they cannot sell it to outside customer. Therefore, this can be considered as the opportunity cost. This is the marginal cost. If X transfer item internally, the minimum price will be marginal cost plus opportunity cost. They will lose opportunity to earn 25,000 margin while it's selling outside. Therefore, opportunity cost 25,000. Therefore, minimum price will be 125,000 rupees. Again, Y can buy this item outside 150,000, the lowest external price. Supplier will supply. This is the lowest price, lowest supplier. Therefore, maximum price will be lowest market price which can purchase that item minus any cost saving. Their silence about cost saving, their maximum price will be 150,000. Therefore, this item for X, now I am advising to X, right? X can transfer this item between two prices, that is 125,000 and 150,000. Any price in between this can be decided as the transfer price. This is the range they have. That range called, the one end called minimum price, other end called maximum price. Therefore, X can decide their transfer price. This price he can decide which price I will transfer. That should be between these two ends. Is that clear? That is the meaning of minimum price and maximum price. Again, let us move into the computer screen. Here also that explanation given, the minimum price 125,000, you can see that, and the maximum price 150. Unfortunately, question not mentioned about the cost saving. Therefore, the lowest price available at the market taken as the maximum price 150,000. Then they have explained opportunity cost. Then I will take this topic. When should market price be used as the transfer price? That is the best topic. Let us read first. If an external market exit for the product being transferred and there is unsatisfied demand externally, the ideal transfer price will be the market price. If variable cost and market price are constant, regardless of the volume of output, a market based transfer price is ideal transfer price. If the perfect external market exit, market price is the ideal transfer price. If an external market price exists for the transferred good, profit center managers will be aware of the price they could obtain or the price they would have to pay for their goods on the external market, and they would inevitably compare this price with the transfer price. The external market is also sometimes known as intermediate market. Now, it's a huge explanation. Let us try to understand this using the whiteboard, right? Now, look this example. In this example, as the maximum price, since there is no cost saving, we have selected market price as the maximum price, right? This has select the maximum price, this is the market price since no cost saving. Now, our question is, when market price that is 150,000 suitable as transfer price, when market price suitable as transfer price. Clear? Let us take the same example. Now, our question, what would be the transfer price, right? I will take the same example. This is the advice we have given them. Keep aside. Now, our question, what would be the transfer price? Assume the external customer will demand for 1000 items. This is the market demand, right? Their capacity, here I will show you their capacity. Capacity means how much they can produce. Say 800 units, their capacity 800 units, but demand 1000. Clear? The external selling price to this customer, say, now marginal cost 100,000, externally you can sell it at say 145,000. Clear? Now you are producing only 800 unit. External market demanded 1000. Under demand, sorry, under supply. You supply lower, they demanded more. Excess demand you have. You cannot satisfy the market demand. Therefore, if you transfer at least one item from X to Y using a different transfer price less than 145,000, what happened? You will make losses. Why? You have purely opportunity to sell entire 800 outside because demand is more. Demand greater than supply. Therefore, you can sell everything outside and make profit. If you decided to transfer at least one to Y division without selling outside, what happened? You will make losses. Therefore, since you have the market demand, since you can't supply the full demand, since you have opportunity to sell your whole production, better to transfer internally also at 145,000 or better to transfer internally at 150,000. Why? If we are not transfer to Y, Y will buy outside from 150. Therefore, you can charge this price also here. No worry. Why? If you are not supply to Y, Y has to buy it outside from 150. Clear? You are supplying everything outside because you are producing 800, they are demanding 1000. Without supplying external market, if you supply them, they will buy if you supply it at 150 or less, because outside also they can buy it at 150. Therefore, no doubt, clearly you can ask 150,000 from Y. If you are not supply, he will buy outside from 150. Therefore, clearly you can charge 150 from Y to supply this to them. That's why when market price suitable when the market demand for the item is excess than the production. In your study text, if you have the study text, please read. If external market exit for the product being transferred, the ideal transfer price will be the market price when there is unsatisfied demand. Therefore, you can summarize when market demand greater than supply, market price is suitable. That means unsatisfied supply. Here 200 unsatisfied supply there. That means you can sell 800 anytime to outside. This type of situation, demand greater than supply. You are supply 800, demand 1000. You can supply entire 800 to the external market without transferring. Therefore, you can charge market price. The second line, if variable cost and market price are constant, regardless of the volume of the output, the market based transfer price is the ideal transfer price. The variable cost and market price constant, these two figures, the variable cost, that marginal cost, that is the variable cost, and the market price constant. What is that? Based on the number of units, this is not changing. Per unit always 100,000 marginal cost. Based on the number of unit, purchase price will not change. In such a situation, you can charge market price from the Y. As the X manager, you can charge market price from the Y, because when the prices are constant means what? Prices are constant. Number 2 situation, market price and variable cost constant. What is this? Can you remember? The fixed price at the market means perfect competition market. පූර්ණතරංකාරී වෙනත පොළ කියලා අහලා ඇති නේද? Perfect competition market. Supplier or buyer cannot change the price. they have to accept the good at a fixed price at the market. Why? There are huge suppliers and huge customers at the market. Since number of huge suppliers and customers in the market for the same type of product, one supplier or one customer cannot change the price or cannot influence towards the price. Both suppliers and customers, huge number of people, use the product, transfer the product between buyer and seller at a fixed price without changing the price. In such a situation, you can use market price as a transfer price. In the perfect competition market, transfer price is the market price. The next line mentioned, if an external market price exceeds for transferred good, profit center managers will aware of price they could obtain or the price they would have to pay for the goods on the external market, and they would inwardly compare this price with transfer price. When the product always has a market, you can use the market price as the transfer price. Therefore, this is very important to keep your mind, and especially under these two circumstances, you can use market price as the transfer price. These type of scenarios tested many times in the past papers. I will discuss past papers in my next session, next video, that is video number 5. This is number 4, right? Here I am trying to explain the theoretical background of the transfer price. Then in next video we can do the past papers, right? Keep this in your mind when you can use market price as the transfer price. Moving into the computer screen now. Let's take, there is an example. You can see that 2.7. First I will read the example. Use the computer screen. A company has two profit centers, A and B. A sells half of its output on the open market and transfer other to B. Then transferor A, transferee B. Sender is A, receiver is B. That understanding is very important, because to solve this type of question you require to understand who is the transferor and who is the transferee, or who is the sender and who is the receiver. The cost and external revenue in an accounting period are follows: division A, division B, and total of the company. External sales of the A, external sales of the B, total 32, cost of production 12 and 10, total 22, and finally company profit is 10. Discuss the consequences of setting the transfer price at the market value. Let's move into the solution. If the transfer price is at market price, A would be happy to sell the output to B for 8 million. Why? Look this question. I have told you A is the transferor, B is the transferee, right? Before moving into the answer, I will take the whiteboard and explain to you how it is happening at the market. Let's have the big picture like this. Okay. According to this question, the two division A and B, this is the company boundary, single company. They are producing an item selling outside, selling price 8 million, total revenue say outside sales, their cost of production 12 million, right? Their external sales 24 million. Their cost also mentioned in the question as 10 million, right? this is a cost, right. Now transfer price setting at market price, at market price. Who is the transferor? A will transfer item to B, that's the story, right. Now A sell their entire sales to outside 8 million. Therefore, this is the market price. If the transfer price set at market price, they will transfer at 8 million internally. That means without selling outside, they will transfer it at 8 million to B. That is called transfer price set at market price. If so, what happened? Let us see. Moving into the computer screen. The solution, part 1. If the transfer price is at market price, A would be happy to sell output to B for 8 million. Clear? Then let us see A, B and company total profit and loss. Market sales, A don't have market sales, but B have market sales. Then transfer sales, transfer cost and the profit. Now try to understand and try to prepare this P&L using your own format without focusing this format. Now what happened? See what happened. A sold their entire sales to B. Clear? Therefore, A don't have market sales. But A transfer entire 8 to internally, therefore A has internal sales. When B bought this item from A, B don't have production cost within their division, but they have sales. Clear? A transfer totally to internally, they have their cost as it is. Now let us take the picture on the whiteboard. Clear? If you prepare P&L for A, B and total for the company, right? Let us see what happened. Sales can be divided into two: external sales and internal transfers. Internal sales, that is transfers, right? Now see what happened. Do A has external sale? No, they don't have external sales, right? A don't have external sale. Do B has external sale? Yes, B will sell it at 24 to external market. Okay, let us try to complete the A's P&L. Do that A has internal sales? Yes, they internally transfer it at 8. Right? They don't have external sales for division A, but A sold it at internally at 8. Right? Therefore, their total sales for division A is 8. Right? B has bought it and sold outside at 10. Therefore, at 24. Therefore, B's sales, external sales 24, no internal sales, total sales 24. When it's come to the company, clear? As a total, this is company will consider only external sales, that is 24 only, because internal sales not as a company. The total means as a company, not as individual divisions. Now let us take the cost, right? When you take the cost, What is the cost? A produce it at 12, B purchase it at 8 and incur their cost of 10. Got it? Right. A produce it at 12, therefore their cost is 12. A's cost is 12. What is the B's cost? B received it at 8, incur this 10, therefore their total cost 8 plus 10. Got it? Now let us see divisional profits. Here loss 4, here profit 6. But when it's come to the company, this 12 is a real cost, this 10 also a real cost, but this 8 is not an external cost incurred externally. Why? That this has paid to the internal division. Since you have eliminated internal sales, you need to eliminate the internal cost also. Therefore, you will eliminate, when it's come to the company, you will take only 22. Is that clear? You will take only 22. Now, see what happened. Your profit is 2. Right? This is what happened when you transfer internally totally. Now, let us move into the computer screen. It explains further in different aspects. See the consequences. A earns the same profit on transfer as on external sales. B must pay a commercial price for transfer goods and both divisions will have their profit measured in fair way. Part 2. A will be insufficient about selling externally or transferring good to B because the profit is same on the both type of transaction. B can therefore ask for and obtain as many units as it's won from A. A market based transfer price therefore seems to be the ideal transfer price. Sometimes without using market price you can go for the adjusted market price. Therefore, your next topic is adjusted market price. Without explaining what is it, I will take example, right, to discuss with you in detail. Let's move into this example. If an external market exit for the product being transferred and there is unsatisfied demand externally, keep your mind. If an external market exit for product being transferred, that is unsatisfied demand in the external market, the ideal transfer price is the market price. We taught that. Suppose a company has two profit centers A and B. A can only sell half of its maximum output of 800 units externally because of limited demand. It transfers other half to its output to B, which also faces limited demand. Cost and revenues in an accounting period are as follows. Division A's cost included fixed production overhead 4.8 million and fixed selling administration cost of 1 million. There are no opening or closing inventories. It does not matter for this illustration whether marginal costing or absorption costing is used. For a moment, we shall ignore the question of whether the current output level are profit maximizing or congruent with the goal of the companies as a whole. If transfer price is at full cost, A in our example would have sales to be of 6 million, that is 30 million minus 1 million into 50%. Full cost price, the full cost not include administration, therefore 13 minus 1 into 50%. Selling and administration costs are not included as are not incurred in the internal transfer. I think you can remember. When you internally transfer a product, you no need to market it. Clear? You no need to design it. You no need to pack it. You no need to deliver it. Got it? When you transfer something, as I explained in the previous Also, when you transfer something internally, no need to pack it, no need to deliver it, you no need to design it, you no need to market it, you no need to promote it, because you just transfer internally, right? Therefore, you can save selling and administration cost. That's why out of total 13 million cost, they have deducted selling and administration 1 million. Then it is become 12. Out of that 50%, that is 6 million. Therefore, they will transfer 50% of their product to division B at full cost. Only 50% they will transfer, that is at 6 million. Therefore, you can reproduce the P&L for the company as well as the two division like this. A will sell half to external market, half to internal market. Clear? Open market sales 8 million, that is external market sale. Internal transfer 6 million at full cost. Therefore, now total become 14 million. B only sell outside 24, therefore their sales 24. Then when it's come to cost, A's total cost 13 including selling and administration, therefore their profit become 1. When it's come to B, their own cost 10, the same example. In addition to that, they will buy it at 6. Here this is sales, here become cost of sale, therefore their total cost will be 16 and this is 9. But when it's come to the company total cost, this 6 is not a company total cost, you will take only 13 and 10, it's become 23. When it's come to the company revenue, this 6 is not a company revenue, only 8 and 24, that is 32, and company profit also 9. Is that clear? Likewise, under different scenarios you can learn this, how to decide the transfer price and what is the consequences in different transfer prices. Let's take the next example, suboptimal decisions. Note also that the level of transfer price increases, its effect on division B could lead to suboptimization problem for organization as a whole. Let's see what is suboptimization decision. For example, suppose division B could buy the product from outside supplier for 10,000 instead of paying 15,000 to division A, that is per unit price, right? This transfer price would therefore force division B to buy product externally at 10,000 per unit, although it could be transferred internally for a variable cost of 9,000 per unit. Although division B would save 500,000 per unit by buying externally, the organization as a whole would lose 400,000 as follows. Now, I think this is better to put like this type of diagram, then you can easily understand. Let's take the whiteboard for the further understanding. Say division A, division B, right? According to the question, their capacity, I will take how much they produce. Their capacity 800 units, right? Let's take the divisions line also. Their capacity 800 units. they are selling only half. I am taking the previous example same, only 50% of production to outside, balance they will transfer to B, right. Now in optimum decision, that B also can purchase this from outside at a separate price, that price also given. I will take the price from the question. For example, suppose division B could buy the product from outside supplier for 10,000 rupees. This is outside supplier 10,000 rupees. Now let us see at which price they are buying from B. According to the question, right, their total sales was 8 million, right. From 8 million, that part goes to them, the part goes to B, right. We have then decided how the A made the soles. In the original example we mentioned A division externally sold entire 8 million. Then in the second scenario may mention A division have external sales and internal sales. The external sales same 8 million, internally they sales 6 million. That was the second scenario. Now we are in the third scenario, right. This was the internal sale. Internal sales is part of the 50% of the production. Therefore sales price 6 million, right. Internally they have sold only 50% of the production, that is 400 million, for that 4 million items, that 400 items, right. Now 600 million is the sales price in the second scenario, sorry 6 million, that 6 million divided by this, then 1, then 5, 15,000. That is explained in your study text, just read and understand. I will take only the figures. Therefore internally transfer they at 15,000, right. Internally transfer item at 15,000 to B, but B can buy it at externally 10,000. Clear? Now this is the story. Now see, B think instead of buying from A, it is better to buy from outside. That is the story. Clear? Now let us see, move into the question again. Now question mention from the second line here, this transfer price would therefore force division B to buy product externally, as we discussed, at 10,000 per unit, although it could be manufactured internally for a variable cost of 9,000 per unit. Let us see how this 9,000 become. Can you remember? I will show you in the screen here, total cost of the division A. This is division A total cost, that is 13 million. In this scenario it was explained here, the total production cost in the division 13 million. This 13 million consists selling and administration expenses 1 million, right. Therefore when it's come to the cost, that selling and administration here 1 million you need to eliminate, because that is not the manufacturing variable overhead. If I calculate here again on the whiteboard, in the scenario 2, this is the note I am referring in the study text, right. You have to read as a flow. Scenario 2 mention division A total cost 13 million, but this consists selling and administration cost. Therefore you need to eliminate that. Then you have only 12 million the production related cost. Then again in the previous scenario they have mentioned some fixed cost here. Let us see that part, moving into the computer screen. Let us read from this point. Division A cost included fixed production overhead 4.8. Can you see that? Division A have 4.8 fixed cost. Now I am again taking the whiteboard. This include fixed cost 4.8 million. Then what is the variable cost? That is the balance, that is 7.2 million is the variable cost. This is variable cost, this is fixed cost. Again, let us move into the computer screen, taking the suboptimal decision. Here you have been given explanation. Now variable cost will be 13 million minus that administration and sales 1 million and fixed cost 4.8, then balance becomes 7.2. Your capacity is 800 units, you are producing 800 units. Once you divide by the 800 units, your variable cost per unit 9,000. Now this is 7.2 million, then you can calculate variable cost per unit like this, 7.2 million divided by your capacity, you are producing 800 units, right. Let us see, 7.2 million divided by 800 units, that is 9,000 is the answer. That is why study text taken as 9,000 rupees, right. Now their variable cost per unit we can put into the diagram as 9,000. They are producing it at 9,000. They are transferring it at 15,000. But we can buy it outside from 10,000. This is the story. Now we are in the story, right? Okay, I think it is clear to you. A producing it at 9,000 variable cost, ignore fixed cost and administration, but they are transferring at 15,000, but we can outside purchase 10,000. Now see the question. Moving into the computer screen. Although division B would save 5,000 per unit by buying externally, the organization as a whole would lose 400,000 as follows. How? Let us see how it will happen. Taking the whiteboard again. What will be happen if this is B will buy this 400, now this is the total capacity, 400 item goes to outside, another 400 item goes inside, right. Without buying from A, B will buy from outside, then for 400 items B will pay 10,000 per unit, clear. But that as a company as a whole, company would be able to produce it at 9,000 within the company. Why I have take this line? This is company as a whole. A will transfer to B at 15,000. It is a separate story. But as a company, right? As a company, this item coming to the company at 10,000, but company can produce within it 9,000. Therefore, this is external buying value, but they can produce as a company this 400 unit at 9,000. Now see, there is a cost saving of 1,000 for 400 units. That means if they buy outside, they have a loss of 400,000. If they produce inside, they have a saving of 400,000. That is the story here. Even a transfer it to be 15,000, that is transfer price, they can produce within the entire company at 9,000. Then why pay 10,000 outside? Now they are paying 1,000 outside based on this. Now B as a separate divisional manager think independently. Why I pay 15,000 to A, I will buy it at 10,000 from outside. But company CEO, as a company CEO, he will look after both division. He will control both division. He will see this. Why we buy at 10,000, we can produce it at 9,000. Look at the complete now. As a manager, he will think, why I pay 15,000, I will buy it 10,000. Therefore, I will show you as the B, as the division B, they will buy it at 10,000 without paying 15,000. Therefore, they have a saving of 5,000 per unit. But as a company, this is the story, they have a loss per 1,000. As a division earn 5,000 profit, as a company earn 1,000 loss. Look at this story again. Head of division A think, why I pay 15,000, I will buy at 10,000 and have a saving of 5,000 for the division. But CEO of the company believe, why I pay 10,000 outside, I can produce it at 9,000, therefore I have a loss of 1,000. Look at the conflict when you give the autonomy for divisions, right? Now let us see the balance part of the computer screen. The overall loss on transfer or purchase 400 units, therefore 400,000 here, you can see this. This loss of 1,000 per unit, assume that any other use of release capacity would produce benefit or less than 400,000. If 400 unit could also be sold externally for 20,000 per unit, the optimum decision for the organization as a whole would to buy unit for division B at 10,000. Now, the final part. This is the story. But if division A can sell this 400 also to outside, right? Now this is the important part, right? If division A can sell this 400 also outside without selling inside, definitely you will have a profit. If so, definitely we want to buy it from outside. If it is buy it from outside, loss is 400,000 for the company. But see, what is the profit you can generate when you sell this outside? If it is more than 400,000, if it is more than 400,000, you will buy this and you will sell outside. Got it? As a company, if we purchase from outside, you have a loss of 400,000. Right? But you can ask me to buy from outside. Okay, you continue the buying from outside. We will sell this outside without transferring to you. Clear? If division A can generate a profit more than 400,000, this loss will be eliminated. If we cannot sell this outside, this loss will be continuous. Got it? Therefore, we can summarize this. Where excess demand at the market supply to outside and ask other division to buy from outside. Compare the profit by supplying outside and the purchasing cost of purchasing inside, the loss of purchasing outside and profit of selling outside. If profit of selling outside greater than the loss of purchasing outside, you can continue it like here. If you purchase outside as B, loss, this is loss, but A will sell this outside and will generate profit more than 400,000, then you will continue this. Clear? When excess demand at the market, you have to compare the profit from outside sales and loss from outside purchase. Outside purchase. If this profit greater than loss, you will ask them to continue. Okay, you do as you wish. Otherwise, you need to control. Therefore, you need to control this situation if there is no excess demand. If there is no excess demand, this loss will continue. You need to control it. Otherwise, you can ask them to continue with the current situation, right? These are the theoretical aspects you need to practice more. Let's move into the computer history again. There is another scenario, just read this part, right? Another scenario explained here, the loss of 1000 per unit, assume that any other use of release capacity would produce benefit of 400,000. If 400 unit could also be sold externally 20,000 per unit, the optimum decision for the organization as a whole would buy outside. Clear? That is the scenario analysis. Therefore, you need to read the studies carefully with my explanation, right? I have explained now what is transfer pricing, what is the purpose of transfer pricing, and how it should be learned with the theoretical aspects. Now we need to discuss further different transfer pricing techniques, and we have to discuss the past papers, how to answer past papers, right? We'll meet with the next video. Thank you very much.